know that a recent study found that only 27% of the workers surveyed plan to retire before the age of 65? Yet 67% of retirees surveyed actually retired before that age.
Chip Coughlin from the Retirement Income Analysis is here this morning. And can you talk a little bit about those numbers first off? Why the big discrepancy there?
Boy, they're a little scary, aren't they?
Yeah.
I think what we're seeing here is people that got downsized in their job perhaps, weren't planning for that time to retire, and also disability and health issues. Took them out of the game, so to speak, but they hadn't planned for it, so they're left in a tough situation.
So when you're planning, where is the income coming from? I guess there's a couple of different sources to think about. Okay,
when you're getting your plan ready to retire, you have to look at what you're going to get from Social Security. Okay, you have to look at what your pension plan, 401k, 403b, IRAs and things like that will have in them. And also your non-qualified accounts. Those would be joint accounts or individual accounts. You want to group those together, put them in a barrel, so to speak, and see what you've got. Do an accounting.
So then, in terms of like what you need to know for people that say, because we plan to retire, right? Those numbers show it. But if you plan to retire earlier, is there a set number or a set value, or you know what I mean, that you should have?
Well, as I've said before, it all starts with a budget, okay, and a cash flow and a net worth statement. And if you want to get out early, you have to have financial goals. Statistically, 42% of Americans aren't ready to retire because they've saved almost nothing. 42% is a pretty high number.
Wow. That's a 42, I've saved nothing.
Exactly, it's pretty scary. So when do you start? As young as possible, okay? And the goal there is put money away on a consistent basis over a long period of time. And that gets you there.
And there's also, in some of those plans that you were talking, there's tax implications that you've got to think about, right?
Exactly. Best case scenario for us when we're working with someone that's getting ready to retire is we want to look at all their assets and how they're taxed. And we want to have a mix of all three. Taxable would be your IRAs, 401ks, 403bs, and a pension plan. Tax deferred would be annuities and things like that. Tax-free would be your Roth IRAs. And then your joint accounts and your individual accounts would have capital gains tax. So what we want to do is mix those together to get the taxable portion as low as possible.
So then are you saying, based on these numbers that we've talked about, that people should maybe have goals of when they want to retire, but know that that doesn't always happen?
You have to plan for the unexpected, okay? And you have to have, your health insurance, your disability insurance. You got to have some life insurance. You got to have some savings in case you come out of the game a little early, not on your own doing. But if you have a goal of retiring at 62, you can take your budget, do some projections, and then back into that number. What will I need? And then you can make a decision to save more of my income, a higher percentage of income, to help you achieve that goal.
Now let's say somebody's watching though, and they have that goal of 62. And maybe they're not there, because you're saying 42% of people don't plan well for retirement.
Correct.
So what should they be doing?
Well, you got to take an inventory, and you have to have a plan. And if you've got time mitigates risk, but it also helps you over the long haul. If you've got time to get ready, you start setting small amounts of money away on an increasing basis over time, you should achieve those goals. But it has to be a goal, and you have to set that goal and you got to stick to it. Your budget will give you the backbone to make decisions on what you should do.
But having the goal is key.
The goal is
key. And time is your friend.
Time is absolutely your friend. I use my daughters as an example. They're 25, 27, and 30, and they started right in their first job, going into that 401k, putting extra money in. Every time they got a raise, they put that money in. They didn't increase their lifestyle. They increased their deposit into that 401k.
Makes sense.
Yes.
It makes sense. It's
sure
all
does.
worthwhile. Thank you, Chip, as always.
You're welcome.
And don't forget, the Retirement Income Analysis has their offices at East Brighton Ave in Syracuse. You can call them at 701-4440 or toll free at 855-44-RETIRE. You can also go to their website, retirementincomeanalyst.com. Chip, as always, thank you.
Thanks for having me.
Thank you.
And stay tuned. We got much more on Bridge Street coming up after this.